I'm Charlotte McLeod with investingnews.com, and here today with me is Ross Norman of metalsdaily.com. Thank you so much for being here. Great to have you.
Likewise, Charlotte. Great to talk to you.
Yes, really, really excited to be speaking with you. I've been following along for the last few weeks your commentary on gold over at Metals Daily, and you've been basically looking into what's been driving this price increase that we've seen. And I think at a basic level, what you found is that it comes down to China. But of course, there's a lot more nuance than that. So I'm hoping you could start by kind of explaining how you got to that conclusion.
Yeah. Okay. Well, let's just rewind slightly in terms of the position year to date. Gold's up, 13%. And a lot of the key drivers that are occurring this year technically should be strong headwinds, not tailwinds. For example, let's remember that the US dollar is very strong at the present time, up 3.46% year to date. 10-year treasuries are up nearly 20%, up 4.7%, close to a 17-year high. Both of these should provide massive headwinds. And of course, the US Federal Reserve are now talking about higher for longer in terms of the rates. In an ordinary market, gold would have collapsed because these are really quite significant headwinds. But what's taken us to the current levels is, well, the first point is to remember that not all buying is equal. Some buying is quality and likely to remain, and some is weak and flaky. And the buying that took us to about $2,050, $2,100 an ounce is arguably some of the very, very highest quality buying that you can have. Central bank buying is off the scale, running at over 1,000 tons for the last 2 years. That's double the run rate of the previous 5 years. And I think the underlying premise of the central bank buying, it's not just BRICS nations, it's also the non-aligned nations, if I can call it that as well, is some people suggest it's the weaponization of the US dollar, de-dollarization. But what's for sure is that there's been a significant increase in sanctions around the world. And let's just call them middle-ranking central banks who must be saying to themselves, we need to have more non-dollar related assets. So central bank buying demand is quality because it's unlikely to be sold if there's a significant price correction. It's for the very long term, big multi-generational. The second area that's supremely strong is China. I mean, you knew that Chinese buying was very good too. And that's also very high quality. And the reason for that is China is what we call a lobster pot. Very easy in, very difficult out. Now, you can export some gold from China as jewelry, but it's quite hard. Predominantly, most metal that goes into the country doesn't come out, and therefore unlikely to be spooked by price action. And the buying that has underpinned China has been its central bank, who've been buying gold for 17 months in a row. Last month, they only bought 5 tons, which is below their run rate, suggesting, if you like, that they are quite nuanced in terms of their buying. In other words, if the price is high, as you would expect, they would throttle back a little. The second area, which is interesting, is on the ETS, which is a securitized form of gold in the stock exchange. China normally features as something of a footnote on those, or Asia does, because it really pales into insignificance compared to the buying in the US in particular, and Europe. But the US and Europe, the West, has been selling ETFs consistently for, year to date. But China's buying. And in the last quarter, they bought, what's the figure they've got now? 29 tons in the last month. So that's quite a high figure. Again, not enough to move the dial entirely, but enough to build a groundswell of interest around China. And then you've got drawdowns on the Shanghai Gold Exchange, running at 522 tons in the first quarter. Now that's large. That's suggesting 2,000 tons a year. Just to remind you, global mine production is only 3,000 tons, if that run rate was continued. So retail buying is strong, central bank buying is strong, institutional buying is strong on the ETF. Added to that, China is having its Costco moment, in the sense that Gen Z and millennials are now buying gold at high premiums, I might add, in gold beans, 4/9 purity, high caratage, and high premium gold beans as a form of storing wealth. The Shanghai Composite Index, its stock exchange, has lost $6 trillion in value since its all-time high back in 2021. China's got a real estate problem. It's got a shadow banking problem. Where do you go to? Well, at the end of the day, gold is no one else's promise to pay. And so, not surprisingly, the young are following the traditional gold buyer, who they call dama or grandmothers. So you've got central bank, ETF, you've got drawdowns on Shanghai. It's across the board. And we knew demand was good. But there was something odd about gold that started from about the 1st of March. Forgive me, Charlotte, I'm doing a lot of talking here. You haven't any questions yet. Something happened to gold from about the 1st of March, 6 weeks ago, that gave it a different meter. It was quite clearly ignoring normal financial market indicators, particularly dollar strength, high for longer, all of those things. The time of buying was odd, early hours London, when the US was asleep. It didn't pause for corrections. It wasn't authenticated by a movement in silver, as we'd normally look to for a step change in gold. All the normal indicators that would point to who that buyer was absent. So it was clear that there was a very significant, a large player in the market, and they were driving it massively higher. Now, it was clear to us that there was large options buying on the London market, and it felt it could be that, and certainly that was a small part of the story on reflection. And then we found out exactly where it was. It was in the data. There's lots of data produced by our markets. The LME may produce a huge amount in addition to. And within that, we saw where the buying was, and the spoiler alert was, well, it's more China, even more than we expected. We keep a close monitor on flows of gold into China. We knew that it was good, but not fantastic, according to the measures that we use. So it was perplexing. And we looked at the Shanghai Gold Exchange, which is the normal place that you would look, and it wasn't there. And then we discovered it was on the Shanghai Futures Exchange. And it's fresh knowledge to us because it's not an exchange which is normally heavily into gold. In fact, the last time that they were significantly into gold was back in 2019. And what they do there, what you have there trading on there are CTAs, a bit like COMEX, pension funds, but anyone in particular who likes to have a massive gearing towards gold. So unlike the Shanghai Gold Exchange, which is quite a physical market, and the physical markets for coins and bars and for beans and the ETF securitized, you have this other market, which is a bit like the CME or COMEX, which is a leveraged way of accessing gold. Now, anecdotally, I can remember giving a presentation to a group of Chinese who came to London. There's about 30 of them, and it was translated into Chinese while I was talking about the infrastructure of the global gold markets. And I can remember at the end of my presentation, the crowd looked distinctly unimpressed. And even with low expectations, this was a fresh low for me. So I asked the interpreter what the problem was. And she huffed and she asked a few questions in the room. And she said, look, they just want to know about massive leverage. Talk to us about options on stilts with a very tall hat. Yeah. And that, I'm afraid, is a part of the Chinese culture. They love to gamble. They like to bet big. Well, this is where, coming back to SHFE, or Shanghai Futures Exchange, where the big move was in gold, running to multiple hundreds of tons. Now, the thing about futures buying, number one, it's not high quality. Why? Because it's easy in and by extension, easy out. Traders are typically agnostic towards the asset. They don't care. They just look to make money. It can be gold 1 minute, soda ash the next. It could be fish futures the next. They just look for mispricing and opportunity. They're very faddish and they move together in size and volume. And I would imagine that with all of this buying at the central bank level, ETF, institutional, physical retail, etc., that these guys in the day were families, and they must have known that there's a strong groundswell within China for gold. And so they bet, and when they bet big. Now, I don't know about this particular webcast, but I know if I show this on Zero Hedge, it will get 35 to 45,000 hits, which is good. Metals Daily would see about 3,000 hits. I don't know what you would get, by the way. But I can tell you that if this was being shown right now to a Chinese WeChat group, you would have between 1 and 1.5 million viewers. And that's for one particular WeChat group attached to gold. So it's not only do they have a strong DNA attached to gold, and are they very herd-like, it's a darn big place too, and lots of them. And that's the point. So the Chinese threw themselves speculatively at gold. They took it to an all-time high of $2,430, $100 above where we are now. And then the market corrected lower. Now, the reason for that is the exchanges, particularly the Chinese exchanges, SG and SHFE, significantly increased the initial margin. It's effectively putting it up a speed bump in terms of trading gold. COMEX did the same, by the way, as well at the same time. The exchanges are saying these markets are too hot, calm down. We're going to make it more expensive for you to deal in them. And it normally takes the steam out of those markets. Well, it did it in China, but it did more than that already, because gold traded, came up very sharply. And at the same time, nickel, following news that the Chinese were to build nickel and tin stockpiles, nickel went up by 6.4% that day, primarily based upon SHFE, Shanghai Futures Exchange, buying. So they're very large and very powerful, and they can move markets. And I think gold caught this. In a nutshell, if you like, gold has moved higher, significantly higher, to around 2,100 on quality buying. The last $200 on top of that, arguably, is of a vulnerable nature, because it's futures buying. The market went to 2,400, and it's come off again. And presently, it's stuck in something of an in-between world, between, being driven high speculatively, but below it is the physical market, the real market, as I would see it, and they're disengaged. The physical market are not buying at these levels. Take the US. Some of these mints, I won't name names and embarrass them, are reporting between 80 and 95% year decline in sales. Some major mints around the world. Just before this call, I sent an email out to the second largest physical dealer in the US. And at the top of the email, bounced back, it said, oh, by the way, please note we've got massive buybacks going on just now. Please be patient with us on reply to your email. And that's indicative of what you're seeing across Europe and across America. Physical clients have switched off. In fact, they've turned sellers of gold. So you've got small coins and bars being sent to Swiss refineries, upgraded, cast into kilo bars and being shipped out to Asia. That flow from the west to the east has always been known. Well, it's a full-bore torrent right now. The metal is just flooding out of the west. The Western investor, and indeed India too, by the way, what the Western investor is saying to us is, yes, we know about the debt issues, we know about inflation, but we feel God's got ahead of itself. And they probably are right. It's moved too quickly, and they get very nervous on sharp moves. When the market corrects lower, we'll buy. So I feel at the moment the gold is sort of being driven higher by speculation. The physical market, which is an important one, has disappeared. But as the market corrects lower, then so the physical buying will pick up, and it will eventually find a floor. Where is that floor? Probably higher than most people think, because I think there's a lot of interested investors that didn't get into this record high. It was a stealth rally. They hadn't expected it. So there's some frustration, and as gold corrects lower, they will jump in, maybe too early, but they will jump in, and that will provide a cushioning effect for when the market bottoms out. From my perspective, in terms of working out where that bottom is before gold rounds out and you want to put your orders in, I always watch the Indian markets because they're keen and sharp traders. They have a sense of when the market's bottoming out. And dealers in India are very sharp at pulling orders as the market goes into free fall, and they have a sense when it's going to round out. So I would watch the Indian markets, watch the premiums or discounts, Loco, Mumbai, to work out when the market's picking up. At the moment, gold is at a high premium in China and a significant discount in India. So there's not much change just yet, suggesting to me we may have, I don't know, perhaps another $100 to go downwards. Last final word on this bit now, and I'll come back to you. This is all short-term stuff. It doesn't fundamentally change anything in terms of the long-term outlook for gold. It's positive for sure. But, it's got ahead of itself. The market was frothy. Some of that froth's been blown off. Probably a bit more to come. When it finds a floor, it will probably have a period of consolidation as the real market comes back into play. Might take 3 or 5 months. And then the market can then start to move higher again. Back to you, Charlotte.
Okay, thank you very much. That was very well explained and very fascinating. So thank you for laying that all out so clearly. And you did answer many of my questions. But one thing I'll ask is, does this mean, I think when it comes to gold, we take a very Western centric point of view in terms of looking at the drivers. It's all, the Fed, interest rates, debt, et cetera, et cetera. Should we be weighing China more heavily now, or is this more of kind of a one-time or rare thing?
That's a really, really good question, I have to say. Too early to say. For sure, this came out of left field. I mean, you look at Shanghai Gold Index and exchange, and you'd see flows, and we measure and monitor most things. SHFE, or Shanghai Futures Exchange, isn't one of those that would have been on your radar, but it will be now. What will interest me, and I haven't done the exercise, is volumes in the US on the futures has also rallied during this period of time, and I wouldn't be surprised if a significant proportion of those trades are actually Chinese trades on the CME in the US. They do a lot of arbitrage between the two. I don't know how much of it is. I don't think your average US speculator is significantly behind this. And the reason I say that is because silver hasn't moved much with it. I mean, it's when you get a move in the markets, you can't help but leave big, fat, muddy footprints across the floor. And you can normally tell from the direction about who it is. And if you know who it is, you know why they're buying. You know why they're buying, you know if it's long-term or just they play a bet. And, you know, what time do they place their bets? How do they place their bets? What do they buy? There's a stack of 6 or 8 really key indicators that give you a really good clue who might be buying. As I say, if you know it's a central bank, back off. They ain't going to back out of this trade. If it's a spec, it's a zero-sum game. They'll chase it higher. With a bit like a 12-year-old high on E numbers, they'll get bored of it and sell it off, and it'll head back to where it was, and they'll try and take profit on the way down. It's meaningless. If it's good physical buying coming out of, I don't know, from the mentioned coins and bars, different story again, quality. So the who is very important, because then you get a sense of the quality of the buying. You know, the quality of the buying, you know, if it's going to be spooked and chase blur again. So that's central to it. Going back to your question about do we need to be sharper on China? Yeah, for sure. The very fact that gold rallied and hit an all-time high, as we're not only talking about higher for longer for the US rates, we're actually talking about possibly, some analysts are talking about the possible rate rise, not a rate cut. And the normal indicators that we would look to here in the West currently are redundant. But it may change as those hot, fast dealers in Shanghai switch to nickel and soda ash futures and other things. Maybe it comes back to our market again. Maybe as the market slips a bit lower, it becomes a physical market again. And that remains the most fascinating thing about gold. It's never one thing. I mean, I don't want to be unkind to my friends on the LME, on the metal exchange. You know, copper, supply, demand, fundamentals, A plus B, you can work out the fair value on that pretty simply. But gold connects into everything. Geopolitics, economics, sentiment, all sorts of indicators. So it's got such a range of drivers, and it's constantly shifting, which makes it fascinating. Some people regard gold as the sum of all fears, in a sense, you know. Pardon me, there's lots of colds going around the moment. And that's why gold's eternally interesting. So should we be more wary of China? Yeah, for sure. Yeah, going forwards.
Okay, certainly. Yeah, and you're so right. There's so many different factors, and as you have also outlined, sometimes they can come out of nowhere. We don't see them coming. So very, very interesting to go into. And
we're just on that particular point. I mean, who would have thought Costco? I mean, what's that about? What I haven't yet done, again, second job to do, and if any of your viewers can tell me, I'd love to know the answer. What premium are people paying for these 1 ounce bars? I try to go onto the Costco website, but you have to be a member in the US to get to see the current price, and then you can work out the premiums. I would venture there's probably quite a high premium they're paying. Bullion dealers are normally priced quite attractively, by the way. But what's interesting about that is the whole new demographic. Interestingly, and again, you'll see on metalsdaily.com, South Korea is having its own Costco moment. It's got a convenience chain called Comsco, and it's again seeing massive sales of small coins and bars in South Korea. In other countries, I don't know what it tells us just yet, but it certainly feels like a new demographic coming into gold. What are we doing wrong as a bullion dealer group? These guys aren't being satisfied through normal channels. I don't know the answer to that question either. So there's a lot to be explored, but it's great that we're getting new people, Gen Z, Gold Beans, Costco, Comsco, all these new angles coming in, something's going right for sure.
Yeah, I don't have a Costco card either, but I've heard that part of the appeal of buying from Costco is you pay with your credit card and you get points when you buy your gold. So maybe these dealers need a points card. I have no idea.
Ah, okay.
Yeah, that's just one thing I've heard.
Great.
Yeah. Okay. Okay. So this has all been really good, and I don't want to keep you too long, but we do have coming up, our traditional drivers of gold. We've got the Fed meeting next week. People are watching that, as you mentioned. I've seen at least one headline saying, maybe it will be another hike in the cards. So, any thoughts on these other more traditional drivers, things we should be paying attention to as we watch gold?
Don't really know. This rally of the last $200 to $300 has ignored all of those factors. I mean, you've had any number, as I said earlier on, of press releases, statements, figures, data that technically should be deeply bearish for gold. What's the fair value? I call it that for gold right now, around 2,100, back to where it was before this suspected rally kicked in. Maybe even lower, bearing in mind we're now talking about much higher for longer. But there is always those curveballs coming in. This is the election year. You've got half the entire planet population going to elections this year, so it naturally spews out vulnerabilities and should we say the possibility of upset, which is keeping people nervous. So it's a funny year, this one. The Chinese, of course, love it because it's the year of the dragon, the only sign which is call it a fictitious one, but very auspicious for gold. Going back to your question, are there geopolitical factors? No, not really. I would think that they're there, but much less so. It might give us an indicator where the physical floor for gold is, whether it's 2,100 or 2,200. I don't know the answer to that just yet, but I think we'll see a bit more downside before we start to see some consolidation. I think I'd be looking at Indian premiums, number one. When does India start to buy? Give us an idea of when we're rounding out. Watching Chinese premiums is an indicator, but less important. Looking at SHFE volumes to see if they have moved on to nickel and other things, or whether their intention is still on gold, whether it's a longer term phenomenon. Half an eye on US elections. There's a feeling in the market that if you look at the betting odds, it certainly seems to suggest that Trump may well win. I follow the money rather than, should we say, Gallup polls, because quite sure people say, follow the money. And the betting odds are slightly in favor of Trump. And were that to happen, I think that would be gold negative. You can't disguise the fact that in the West, in Germany and in the US, gold is associated, should we say, with right of centre rather than left of centre politics. And if you had your own man in power, then what's your need for protection? And it happened last time with Trump's first presidency. It certainly came off. So quite possibly towards the end of the year, we might see a little bit of price softness on the election. That would be worth watching as well. And watch central bank buying. It's been one of the key drivers. I would expect a bit more fade on that really high quality buying. I think they're much more nuanced now. They don't tend to chase markets high. They don't have a program and just buy 120 tons. They now look at the market and judge it. Shame that Gordon Brown, the UK Chancellor of the day, didn't follow that advice when he sold off half the UK's reserves. But there we go, move on. So there's a few keys and clues out there that you can follow to give you an indication of when the market's starting to find a floor, when the real market's engaging, but the specs are still happy enough to be engaged as well. What's India doing? Are they still engaged? A lot of that, and forgive the pun, pushing the brand, a lot of that you'll find on metalsdaily.com.
Okay, and one small question before I let you go on silver. So, you mentioned fair price for gold, 2,100, I think is the level that you mentioned. Is silver fairly priced right now? Because I think a lot of people are looking at gold historically high, and they know that silver follows gold eventually, although it lags behind, but they want to see silver higher. But if gold is, actually should be priced lower, how is silver looking in that case?
Just 5 minutes before we went live, I thought, you know what? He's going to ask about silver. And do you know why I knew that, by the way? Because I talked to Western interviewers and Asian ones, and they never raise silver, but Americans always trade it. There's a reason for that. American speculators and investors love silver in the way that we don't. Just to be clear, by the way, in Europe, physical silver attracts tax, or VAT as we call it, at 20%. So making physical ownership a nightmare. You don't do it. You've got high premiums plus tax at 20%. So it makes it unattractive. Of course, you can buy as an ETF, but that's another story. So I think silver is very much and that's why, by the way, historically, you'd look for silver to authenticate the move in gold. Silver will move first because the speculators, especially in North America, would get behind silver because it's normally regarded as a leverage play on gold. It normally starts, silver, I've got to declare this prejudice up front. I don't like silver very much because it's boring. It tends to follow gold around. And a bit like the intern at the Christmas party, it's very quiet all year round until the Christmas party that disgraces itself on a glass of sherry too many. And that's silver. But it's worth watching because when silver moves, it tells you that the whole complex is going through an inflection point. But it didn't happen this time. It didn't happen on this move on the 1st of March. And the reason for that is because unusually it wasn't the US that developed the rally in gold. It was China. And they don't have the same attitude towards silver that you do. Anyway, going back to your question, gold's up 13% year to date. Silver's up 15% year to date. It's slightly outperformed it. If you felt so, in an ordinary bull run, yes, you'd buy silver because it would outperform gold to the upside, and we're bullish gold. But it's not a US-centric rally, so yeah, temper that slightly. The Chinese don't have the same love of silver like the Indians and the Americans do. So yeah, we remain positive towards it, but perhaps not as outrageously as you might be if it was an American fund rally.
Okay. Thank you for going into silver. Sorry to make you talk about that one. Very funny that you anticipated that question, though. Okay. This was really good. Thank you so much. I will let you go unless you had any final thoughts or you want to know or let people know where to find you to learn more.
Yeah, so my name is Ross, as you got, Ross Norman. I'm leading gold price forecaster within the LBMA over 24 years. Proud boast. Forgive me for that. So we have a website which we believe is the largest and fastest source of precious metals news. Come and have a look. It's all free. And hopefully enjoy it as well. And thank you, Charlotte, for your time today. Really enjoyed talking to you.
Oh, of course. This was great. Thank you so much. Hope to have you on again. And once again, I'm Charlotte McLeod with investingnews.com. And this is Ross Norman with metalistdaily.com. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.